this video, we're going to review and debate whether the SPY ETF or the QQQ ETF is the better buy now if you're just starting to invest today. Now, here's a quick video overview. First, we're going to check out QQQ and SPY's latest top holdings as of today, their weights, and compare the two ETF. Second, we'll review the ETF's top sectors and see if these market sectors are set to overperform or underperform in today's environment. Third, I'm going to share with you some of the less popular but awesome and different ETF variations and alternatives for QQQ and SPY. And finally, fourth, we're going to check out these ETFs' past performances, and I'll share with you my opinion on what I think about the performances in the next few years. The QQQ ETF has a management expense ratio at 0.2%. The SPY ETF has management expense ratio, or MERS, at 0.09%. But you can enjoy this video for free if you could just take 1 second to like this video. That would be much appreciated. Okay, so let's get started. QQQ is Invesco's ETF that aims to track the performance of Nasdaq 100, a stock market index that contains the top Nasdaq companies. Meanwhile, the SPY is State Street's ETF that aims to track the performance of the S&P 500, a stock market index that tracks the top 500 companies listed in the US. Now, which of these ETF is the better buy long term if you're just starting to invest today and you're building a long-term core position? Now, it makes sense for us to look at the different weights for both of these ETFs. Okay, so on the left, QQQ has roughly 12% in Apple, 11.7% in Microsoft, 10.4% in Amazon, 4.15% in Facebook, 3.71% Alphabet A, which is Google, 3.62% Alphabet C shares, followed by Intel, Nvidia, Adobe, and PayPal. I wanted to highlight the big mega tech stocks, the Apple, Microsoft, Amazon, Facebook, and Google. These 5 companies actually consist of over 45% of the total ETF weight. This means that the weight of these 5 companies are already half of Nasdaq 100, which essentially means if you invest in the QQQ, half of your investment will be going into these 5 companies. Okay, on the right, SPY's top holdings are 6.48% in Apple, 5.5% in Microsoft, 4.5% in Amazon, 2.2% in Facebook, 1.6% in Alphabet A, 1.58% in Alphabet C, 1.53% in Berkshire Hathaway, followed by Johnson & Johnson, Visa, and P&G. The big mega tech stocks here, the Apple, Amazon, Microsoft, Facebook, and Google here, consist of 21.96%, which is significantly less than the 45.7% we had in QQQ. Now, I'm actually going to treat Berkshire Hathaway as a technology stock due to their significant stake in Apple, and now they've also invested in Amazon and companies like Snowflake. It really seems that Warren Buffett and their traditional value investment is now changing. If we add the Berkshire Hathaway percentage to the 5 mega tech stocks, that gives SPY a total weight of 23.5%. This means the 5 mega tech stocks plus Berkshire Hathaway consists of roughly 1/4 of the S&P 500 weights. One major difference between the QQQ ETF and the SPY ETF comes down to the mega tech names. Whether you're interested in going with 45% tech heavy or you're going with 23% tech heavy. After the recent technology stock sell-off, a lot of investors are moving their money from the overvalued tech stocks to the slightly undervalued other sectors. And many people are starting to worry about tech stocks. In my opinion, and based on past data, technology stocks will be just fine if you're willing to invest long-term and if you're patient enough. When looking at mega tech names like Apple and Google, Facebook, Amazon, and Microsoft, you know the tailwind is on their side. With big themes like AI, 5G, e-commerce, social, cloud, and data. So in my opinion, in the long term, QQQ is the winner of the two. Now that's for the long term. What about for the short term and medium term? If your investment time frame is shorter and it's not for the long term, are there other sectors that could possibly outperform technology stocks in the short and medium term? It makes sense for us to look at the different sectors for SPY and QQQ. At the time of the video, QQQ allocated about 48% in information technology, 20% in communication services, 17% in consumer discretionary, 7% in healthcare, roughly 5% in consumer staples, 2% in industrials, and 0.66% in utilities. In the case of SPY, there's a more diverse sector allocation, with 27.5% in information technology, 10.8% in communication services, 11.3% in consumer discretionary, 14% in healthcare, 7% in consumer staples, 8.5% in industrials, and 9.9% in financials. And then you have the materials, utilities, energy, real estate filling up the remaining pieces. One big area to highlight between the two ETF is that QQQ has no exposure in financial stocks. And on the other hand, SPY has roughly 10% of exposure in financial stocks. On the other hand, SPY does have 14% allocated to healthcare compared to 7% in QQQ. Personally, I'm very optimistic about the healthcare sector in the next few years. Now think about what just happened in this world. So it's a no-brainer, more and more resources are going to be allocated to the healthcare sector in the next few years. The 8.5% allocated industrial stocks is also a good play for SPY. As gradually the economy recovers, you'll see companies like Honeywell, companies like 3M, companies like Caterpillar do very well. In the short and medium term, I would say the SPY has a slight edge over QQQ as it is more protected from the continued tech sell-off, as well as the allocation in higher healthcare percentage, plus the recovery play in industrial stocks. Okay, now part 3 of the video. What are some other alternatives to play the QQQ ETF and the SPY ETF? Let's look at some options. The first one is XLK, State Street's Technology ETF. Now, this ETF covers all the tech stocks in the S&P 500, and it's got MasterCard and Visa as its top holdings. This is great because this ETF treats MasterCard and Visa as technology stocks, and in my opinion, they should be treated as tech stocks, as the future of fintech. QQQ, on the other hand, doesn't have MasterCard, doesn't have Visa, which I think is a shame because these two companies, you know they're going to be performing very well in the long term. Another alternative for QQQ is IYW, BlackRock's iShares US Technology ETF. Now, IYW takes a more aggressive approach in tech stocks and covers all the small, medium, and large tech names. Personally, in my opinion, I think IYW has the highest potential to perform best out of all the tech ETFs, simply because it's got all the different cap names. There's also VOO, which is Vanguard's S&P 500 ETF. This is essentially the same thing as SPY, but it's got a much lower management expense ratio at 0.3% compared to SPY's 0.9%. Another alternative to consider is VOOG, Vanguard's S&P 500 Growth ETF, as well as SPYG, which is SPY's Growth ETF. These are just basically the VOO and SPY, but focusing more on the growth stocks. Both VOOG and SPYG are great long-term investment in my opinion. Now, part 4 of the video, how did all of these ETFs perform in the past 5 years? Let's have a look. We can see that SPY, which is the line in pink, if you invested in 2015, you would have had a 69% return. And if you decided to be more aggressive and add more growth, which was what we talked about earlier with the VOOG and SPYG, this would have given you 104%. The 3 tech ETFs, the QQQ, IYW, and XLK. QQQ returned 156%. XLK returned 178%, and IYW returned about 188%. So as you can see in the long term, generally technology stocks will outperform the broader market in the long run if you hold the stocks long enough. Now, there's also an exception to this. If you invested in technology ETFs in year 2000, you see that in the next few years, it is that the SPY actually outperformed all the tech ETFs. Personally, in my opinion, I think it's good to allocate some budget for both the SPY and QQQ for the long term. In allocating between the S&P 500 ETF like the SPY versus technology ETF like the QQQ, I would put 40% of my ETF money in the S&P 500 index and 60% of my ETF money in a tech stock ETF like the QQQ. Again, this is because in the long run, technology stocks will most likely outperform the broader index. So even if 2020, 2021, 22 ends up like being year 2000 where tech stocks just underperform the broader market, that's actually good in my favor because I will be contributing more into the tech ETF. And as they climb back up, you'll have more shares. At the end of the day, all these ETFs are great long-term investment, and I don't think you can go wrong with any of them. I hope you enjoyed the video and you would be able to pick up some valuable information. Thank you for watching. This is Young Investor Guy signing off. I'll see you guys next time.